Hey, welcome back. Welcome to my discussion on property, plant, and equipment, or planned assets, where today I want to talk with you about accounting for exchanges. Our goal then is to learn how to do the accounting for exchanges. There are two types of exchanges that exist in the accounting world. It's always at least two types, right? They're grouped into those that have commercial substance, which in a nutshell means that cash flows are going to change, hopefully increase. Why would you do it otherwise? And then the second category of exchanges are those that lack commercial substance, which means that although an exchange is taking place, your cash flows will be unaffected in the future. I'd like to note right now at the beginning that we always use the fair market value plus or minus any cash we might have gave or received of the asset that we've given up as our first choice in the accounting for exchanges. If we don't know the fair market value of the asset we've given up, then you can use the fair market value of the asset you received. But your first choice is always the fair market value of the asset given up. So, let's look at some exchanges. First thing I want to do is graph it out a little bit, commercial versus non-commercial. So, we're into an exchange where we've given up one asset for another, and we're looking at, does it have commercial substance? Will cash flows change? If the answer is yes, we do one kind of accounting, and if the answer is no, we do another type of accounting. So let's start there. Let's begin with commercial substance. If it has commercial substance, we're going to use the fair market value plus or minus any cash of what was given up to value our new asset, and we will recognize any gain or loss. The idea here is a real transaction has taken place that affects future cash flows. Now let's assume that there is no commercial substance. Commercial substance is lacking. If that is the case, we're going to record the new asset at the book value of the asset given up. If there's a loss, we'll record it. Because anytime we've suffered a loss, it's okay to record it. In fact, generally accepted accounting principles want you to. If there's a gain, you don't record it. How's that for different? So it's okay to recognize losses, but it's not okay to recognize gains. So there is a little exception for that, and we'll look at that in a second. And that's if you receive cash. But let's first say you paid cash. So you record the book value of what you gave up plus the cash you paid. And you recognize a loss if there is one. But you don't recognize a gain. Rather, you absorb the gain to the cost of the new asset. I'll illustrate that for you. How, though, about if you received cash? If you received cash, you would record the value of the new asset at the book value of what you gave up minus the cash you paid. And if there's a loss, it's absolutely okay to recognize. And if there's a gain, you can partially recognize it. Why? Because the transaction was part cash. How much of a gain do you recognize? The answer to that is it's the percent of the gain that cash made up of the transaction. So if you take the fair market value of what you gave up plus the cash, you figure out what percent cash is of that total amount and recognize that percent of the gain. Your author illustrates this in an example in the book, but then doesn't offer any homework on it. So we'll recognize that if you have no commercial substance and you receive cash, that a loss is okay to recognize in full, and a gain would be recognized in portion to the amount the cash represented of the transaction, but it won't be tested on where you calculate things, and it won't be in your homework. It might show up on a test in that it would say, is it okay to recognize part of a gain? And if you received cash, you would say yes. But there'll be no calculation kind of questions because there are no calculations involved in what the offer has. Let's move forward and look at an example now. In my example, we're going to exchange an old tractor for another old tractor that is better suited for our needs. It fits the layout of our land better. The cost of our old tractor was $100,000. Its accumulated depreciation, which we have brought up to date, is $20,000. We're going to pay an additional $10,000 cash, and according to an appraisal, the fair market value of our old tractor is $95,000. The fair market value of the new tractor is irrelevant because we have a good number for the fair market value of what we're giving up. I'm going to do this transaction showing commercial substance and lacking commercial substance, so you can see them and compare. As always, I like to start in a journal entry with an analysis of the situation, so let's do that. We have the cost of our old tractor being, I'm going to say old whenever I reference this so we don't get lost on where we are, since two tractors are now involved. The cost of our old tractor was $100,000. Its accumulated depreciation, which was brought up to date through today as this transaction happens, was $20,000. So that means the book value of our old tractor on our books is $80,000. We're also giving up. I need to increase that book value. We're paying cash of $10,000. So the total book value, I'm going to abbreviate book value, the total book value of what we give up, which is what we want to start with, if it's what we want to use, if we can, is $90,000. Now, the fair market value of this exact tractor is $95,000. So, there's the phone. Hold on. Bet you would have guessed that's my sister if you've listened to all the videos I've been making. Of course it is. Anyway, so the book value of what we gave up is $90,000. The fair market value of our old tractor, which is what we're going to use because it's our first choice, is $95,000. And from all of this, is that a gain or loss? If you give up $90,000, the fair market value of what you get is $95,000, then you have a gain of $5,000. So this then is the set of facts I'm going to use. I think it's more complete to use a gain, because in a loss, in all cases, we would have recognized it. But in a gain, you recognize it if it has commercial substance, but you don't if it doesn't. So I'm taking the one with the exception. Are you ready? So here's where it's going to split. Does it have commercial substance? And the answer is yes. How would you record the transaction? Well, first, you need to get rid of the old tractor. I'm going to start then by crediting the account old tractor. And you really wouldn't say old, but we're going to for my example. And its cost was $100,000, so I'm going to credit it for $100,000 to get it off the books. Then I would debit accumulated depreciation. Notice I'm just following my analysis above for $20,000. In my entry now sits book value of $80,000. I'm paying cash of $10,000, so I better credit cash for $10,000. And I'm getting a new tractor. I really wouldn't say new, but I'm going to. In the amount of $95,000, and notice I paid, or I'm recording, the fair market value of what I gave up plus some cash I paid in this entry. And I would recognize a gain on it. So I've got my new tractor recorded, and I'm going to recognize a gain in the amount of $5,000. Let's see if my journal entry balances. Boy, will I be mad if it doesn't. And it does. I have $115,000 in credits and $115,000 in debits. And notice I recorded the new tractor at the fair market value of the old plus the cash paid, which is what we said we were going to do. Now, let's look at this transaction if it has no commercial substance. And it will be recorded at the book value of what was given up plus any cash paid. And no gain can be recognized because it lacks commercial substance. And the first thing I'm going to do, and this will make you laugh, is I'm going to do it wrong, okay? I am doing it wrong. I know I'm doing it wrong, but I'm doing it wrong because then I'm going to change it and make it right. And I believe when I do that, that will exaggerate it enough so you'll remember it better. So we'll do it wrong, and then we'll fix it. Are you ready? Wrong constitutes recording the transaction as I did when it had commercial substance. So let me write that down. I'm not going to put you on hold. I'm just going to walk through it. So, to do it wrong would be to pick up the new tractor at $95,000. Get rid of the accumulated depreciation. That part's correct. I have to get rid of $20,000. It would look silly sitting on the books alone. I need to get rid of the old tractor. That part was right. I have to get the old tractor off the books at $100,000. I have to pick up the cash I paid. That's correct. I did pay $10,000. And then there's the gain I'm recording that I'm not allowed to in the amount of $5 because you can't recognize a gain on this transaction. It lacks commercial substance. We're supposed to record it at the book value of what we gave up plus any cash. Well, the book value of what we gave up was $80. There it is right there, plus cash at $10. So we should be recording it at $90 and not recognizing a gain. So it will take the 95 off and change it to 90. I just absorbed the gain into the cost of the new tractor, and I'll take the gain off the journal entry. So that fixes the old journal entry, and the way that it really should look would be you would show the new tractor with the gain absorbed at 90. Get rid of the accumulated depreciation of $20,000. You can't change that. It is what it is. Get rid of the old tractor. Needs to go. Don't own it anymore. I'm abbreviating. Get rid of the old tractor at $100,000. And get rid of the cash because we just spent 10 at 10. Does our entry balance? Yes, both sides equal 110. There is no gain because it was absorbed into the price of the new tractor. Now, if there was a loss, I would have recognized it both with commercial substance and without. It would have been a straightforward transaction. I showed you the more difficult one where there is a gain, and it's recognized normally when we had commercial substance. Just recognize the gain, and it's absorbed into the book value of the old asset when we lack commercial substance. There you go. I am not going to do an example where we receive cash. There's an example in the book. We can talk about that if you want, but it won't show up in your homework. You might be asked a question on it, and the only answer you could give that would be right would be, well, if you receive cash, it's okay to recognize a portion of the gain, and that would be the portion that the cash represented of the whole fair market value of the transaction. Thank you for joining me on this lovely January day as we look at non-monetary transactions or exchanges. Talk to you soon. Bye.